5 coins, 1 ranking, and by the end of this, you're going to know exactly who's fighting whom in this space, what each side actually needs to win, and which one of these 5 is quietly winning while everyone's still arguing about the wrong one. Let's start at the bottom, because the bottom of this list tells you more about this entire sector than the top does. Flare sits dead last, and I want to be clear about why, because it's not because the technology's bad. Flare's entire pitch is interoperability, pulling data and value across chains that otherwise can't talk to each other, powering things like facets and its Oracle system. On paper, that's a genuinely useful piece of infrastructure. But being useful and being in demand are two completely different things. And right now, the market is telling you loudly which one of those Flare actually has. This asset is down close to 90% from its all-time high, down over 70% just in the last year alone. That's not a dip. That's not buying the fear. That is a market that has looked at what Flare is offering and decided repeatedly over and over that it does not want it at any price point that matters. Let's see who's fighting whom in Flare's corner of this space. On one side, you've got the builders and the true believers, the people who understand the FTSO system, who see the Oracle infrastructure as genuinely differentiated, who point to the technical roadmap and say, the market just hasn't caught up. Yet, on the other side, you've got everyone else, the traders and the capital allocators, who look at a token that shed the overwhelming majority of its value and ask a very simple question. If this technology is so necessary, where is the demand? Where are the enterprise integrations that move the needle? Where is a single headline in the last few months that made anyone outside the existing holder base sit up? The bulls need adoption to show up in the price. The skeptics need the price to keep confirming what it's already been telling them for over a year. Right now, the skeptics are winning, and they're winning by a landslide. Dig a little deeper into what's actually happening here, and the picture gets even more uncomfortable for the bull case. This isn't a coin that had one bad quarter and is due for a bounce. The 7-day performance has continued to bleed even during periods when the broader market found some. Stability, that matters because it tells you this isn't purely a beta play riding Bitcoin's mood. This is an asset getting sold independently of what the rest of the market is doing, which is usually a sign that holders themselves have lost conviction, not just that macro conditions are unfavorable. When an asset underperforms during a market-wide relief rally, that's the chart quietly telling you the demand problem is internal, not external. And here's the part of the Flare story that almost nobody says out loud, because it's an uncomfortable thing to say about any project in this sector. Sometimes the technology being genuinely interesting isn't enough. Interoperability and Oracle infrastructure are commodity services in this industry now. There are multiple projects solving similar problems and being one of several options instead of the singular obvious. Choice puts enormous pressure on a token to prove its specific implementation is worth a premium. Flare hasn't made that case to the market yet, at least not in a way the price reflects. And until it does, this is where it sits, dead last. Not because the concept is worthless, but because the concept and capture are two different things. And right now, Flare has plenty of the first and almost none of the second for XDC Network. And this one's more interesting because XDC actually has something real happening right now that Flare doesn't. A live integration with Stripe's own bridge infrastructure for stablecoin settlement, which is a genuinely significant piece of news for a coin built around trade finance and real-world asset tokenization. That's not nothing. That's a Fortune-level payments company plugging into XDC's rails for actual settlement flow. But here's the problem, and here's the fight happening inside this one. XDC's market cap is sitting under $600 million. And depending on which tracker you check, the numbers don't even agree with each other. One source says the price is $0.026, another $0.033, a third puts market cap at $557 million, while another says $591 million. Million, when the basic numbers for an asset can't even agree across major platforms, that tells you something about how thin the liquidity actually is here. So who's fighting whom on XDC? On one side, you've got the trade finance believers who see the Stripe bridge integration as proof the fundamentals are catching up to the thesis. Real institutional plumbing finally showing up after years of any day now promises. On the other side, you've got the liquidity realists who look at a genuinely important partnership landing on a sub-$600 million market cap with inconsistent pricing data across exchanges and ask a very simple question: if this technology is so serious, why hasn't the market decided this is a serious asset yet? The bulls need volume to follow the news. The realists need to see that volume actually show up before they'll believe the story is real, instead of just promising. Right now, this fight is genuinely unresolved, which is exactly why XDC sits in the middle of this list instead of the bottom or the top. Think about what the actual Stripe bridge integration represents for a second, because it deserves more credit than the price action is currently giving it. Bridge is Stripe's own stablecoin infrastructure, built by a company that processes payments for a meaningful share of the internet's e-commerce. When that kind of company chooses to route stablecoin settlement through a specific network, that's not a marketing partnership. That's an operational decision made by engineers and risk teams who evaluated alternatives and picked this rail. That carries weight. It's the exact kind of validation the trade finance thesis behind. XDC has been promising since this project was still called SynFin, but weight on paper doesn't automatically become weight in a chart, and that's the frustrating position XDC is occupying right now, with daily trading volumes sitting in the single-digit millions, and pricing data that varies meaningfully depending on which exchange or aggregator you check. This is still structurally a thin market. A big institutional integration landing on thin liquidity creates a strange dynamic. The news is real, the fundamentals genuinely improved, but the market hasn't built enough depth around this asset yet to reflect that improvement cleanly. That's the position XDC is stuck in. Good news, thin tape, and a market still deciding whether to believe it. 3. HBAR, and I know this is going to upset some people watching this, because on paper, Hedera has the best story of any coin on this list. A governance structure that includes Google, IBM, Boeing, Deutsche Telekom, actual global institutions, not speculative partnerships, sitting on a council steering network direction. That is a genuinely unique structural advantage. No other asset in this space, XRP included, has that level of direct enterprise governance built into its architecture. So why is it sitting at number 3 and not number 1? Because governance and price are two battles. And right now, HBAR is losing the second one badly. This asset is down mid-single digits just in the past week, and it's sitting dramatically below its 2021 all-time high. Down somewhere in the, here's the fight happening inside HBAR right now, and it's the most important tension on this entire list. On one side, you've got the fundamentals crowd, and they're not wrong. They point at the council, they point at the enterprise use cases already live on the network. They point to the sheer weight of the names attached to this project and say the price simply hasn't caught up with what's actually been built. On the other side, you've got the capital flow realists, and their argument is just as strong. Having Google and IBM on a council means nothing to a price chart if that backing hasn't translated into the kind of institutional capital allocation that shows up as sustained buy pressure. XRP got spot ETFs. HBAR has not. And until that changes, or until council level partnerships start translating into opportunities on chain, volume that actually moves the needle, the fundamentals crowd is going to keep losing this argument to the people. Just looking at the chart right now, the skeptics are winning, and they're winning by a landslide. So this is the coin on this list I think about the most, honestly, because the gap between what's actually built here and what the market is currently pricing in might be the widest of any of the five. That gap is either the best opportunity on this entire list or a warning sign that governance alone doesn't move price. Both of those things can be true at the same time, and that's exactly why this one sits in the middle instead of the top. Consider the actual mechanics of what a council structure like this is supposed to accomplish. The entire pitch behind putting Google, IBM, Boeing, and Deutsche Telekom on a council isn't just optics. It's supposed to mean these organizations have operational reasons to build on this network, which theoretically translates into real transaction volume, real fee generation, real usage that isn't dependent on retail speculation. And to be fair, some of that has materialized. There are enterprise use cases live on Hedera right now that don't exist on most of the other chains on this list. But here's the honest truth sitting underneath the Hedera story. The names on the council are as impressive as any in this entire sector, but impressive names without impressive usage. Numbers is exactly the gap the skeptics keep pointing to, and it's a genuinely fair point. The fundamentals crowd isn't wrong that this infrastructure exists. The capital flow realists aren't wrong that infrastructure sitting mostly unused doesn't justify a premium valuation. This is a real, ongoing argument, and until one side produces undeniable proof, either a surge in actual network fee revenue or a continuation of the price weakness. That's been the story for months. HBAR stays exactly where it is, stuck between the best story on paper in this entire sector and a market that stopped taking stories at face value. Number 2, Stellar. And I want to be honest with you about why this one isn't higher, because on pure hype basis, it probably deserves more attention than it gets. XLM had a real, verified, meaningful moment recently, a private credit deal worth $1 billion moving onto the Stellar network through Tradable, which is exactly the kind of real-world asset tokenization use case this entire sector keeps promising, and rarely delivers at this scale. That's not speculation. That's not a partnership announcement with no follow-through. That's $1 billion of actual private credit assets choosing this rail. So why isn't Stellar up atop? Because Stellar's entire personality for years now has been reliability without spectacles. It doesn't have the ETF story XRP has. It doesn't have the governance story HBAR has. What it has is a track record, cross-border payments infrastructure that's been quietly working since 2014. A burn event in 2019 that showed the foundation was willing to make hard supply decisions, and a price chart that, while it's had real drawdowns from its own all-time high, hasn't been the roller coaster that HBAR or Flare have been. Here's who's actually fighting over Stellar's positioning. On one side, the quiet compounder crowd who will tell you that boring is exactly what you want for infrastructure that's supposed to move money reliably at scale. You don't want your settlement rail to be exciting. You want it to work every single time. On the other side, the momentum crowd who look at Stellar's relatively modest $6 billion market cap next to XRP's $66 billion and ask why a network with a genuinely major institutional deal in hand isn't getting anywhere near the same attention or capital allocation. Both sides have a point. Stellar is arguably the most undercovered asset on this entire list relative to what it's actually accomplishing. And that's exactly why it sits at number 2 instead of lower. The fundamentals are real, they're just not loud. Look closer at what the tradable deal actually means structurally, because $1 billion in private credit assets is not a small commitment for any blockchain to absorb. Private credit is one of the fastest growing corners of institutional finance right now, and the firms operating in that space are notoriously conservative about which infrastructure they're willing to trust with real capital. Choosing Stellar for that kind of deployment says something meaningful about how the network is perceived at the institutional level, not as an experiment, but as production infrastructure capable of handling assets that carry real legal and financial weight if something goes wrong. That's a different category of validation than a partnership announcement with a pilot program attached to it, and yet the price barely moved on it. That's the frustrating paradox sitting at the center of the Stellar story. A network can be doing exactly what it's supposed to be doing, quietly, reliably, moving real institutional capital, and still get almost no market recognition for it, because the broader retail attention driving most crypto attention is trained to respond to volatility and headlines, not steady accumulation of institutional trust. Stellar's momentum crowd isn't wrong to be frustrated by that, but the quiet compounder crowd would tell you that being underappreciated by a market obsessed with short-term hype is not the same thing as being wrong about the asset's long-term positioning. Sometimes the market takes years to catch up to what the fundamentals have already confirmed. Which brings us to number 1, XRP. And I'm not going to pretend this is a close call, because the gap between XRP and everything else on this list isn't a gap, it's a canyon. $66.5 billion in market cap. The next closest asset on this entire list doesn't even break $6 billion. That's more than a 10-to-1 gap between first and second place. And the reason for that gap has a name, and it's spot ETFs. Bitwise, Grayscale, 21 shares, Canary, Capital, Franklin Templeton, 5 major issuers all offering regulated exchange-traded access to this asset, listed on the NYSE, NASDAQ, and CBOE. No other coin on this list has that, not one. That is the single biggest structural advantage any asset in this entire sector currently holds. And it's not close. But here's the fight actually happening inside XRP right now. And it's worth understanding because it's not as simple as XRP. Wins? End of story. The bulls point at the ETF infrastructure and say this is exactly the kind of institutional on-ramp that turns speculative interest into sustained, boring, recurring capital flow. The kind of flow that doesn't care about hype cycles because it's driven by allocation models, not sentiment. The skeptics point to something uncomfortable in the recent data. ETF inflows have gone almost completely quiet. Multiple trading days in July registered $0 of net flow. Multiple 3-day stretches where nothing moved at all. A fund complex holding close to $1 billion in assets saw barely $12 million of net demand across an entire month of trading. That's not the picture of overwhelming institutional conviction. That's the picture of a market that got its ETF approval, celebrated, and then went quiet, waiting for the next catalyst. So here's the actual tension at the top of this list. XRP has the infrastructure advantage that nothing else on here can currently match. 5 regulated products, major exchange listings, real plumbing connecting this asset to traditional finance in a way none of the other 4 have achieved, but infrastructure without flow is just plumbing. Nobody's using yet. The bulls need those ETF desks to wake back up. The skeptics need the quiet to keep proving that regulatory approval alone doesn't guarantee capital shows up behind it. Right now, XRP wins this list not because that fight is settled, but because even in a quiet month, it's still sitting on more institutional infrastructure than the other 5 combined. look at exactly how quiet things have gotten, because the specifics matter here. Over a recent 17-day trading stretch, 10 of those days registered exactly $0 in net ETF flow, not small positive numbers. 0, including stretches of 2 and 3 consecutive blackout days in a row, one of which ran straight into the end of the month, against the fund complex holding close to $1 billion in assets. Net demand across that entire period totaled roughly $12 million, a number so small relative to the size of the complex that it barely moves the needle on anything. Daily trading value has also been thinning, dropping by more than a third over just a few weeks. That is not the picture most people have in their head when they think about what a spot ETF approval is supposed to deliver. But here's why that quiet period doesn't actually change where XRP sits on this list, even though it should absolutely make you cautious about assuming institutional demand is automatic. The infrastructure itself, the 5 issuers, the exchange listings, the regulatory approval, doesn't disappear just because flows went quiet for a month. That plumbing stays in place regardless of short-term sentiment. And unlike the other 4 assets on this list, XRP doesn't need to build that access point from scratch when institutional appetite eventually does pick back up. It already exists. The other 4 are still trying to get regulators and major issuers to build them a version of what XRP already has sitting idle. That's the actual argument for XRP staying on top even during a quiet stretch. It's not about current flow, it's about who already has the door built versus who's still trying to get the blueprint approved. So that's the order. Flare at the bottom, still searching for demand that matches its technology. XDC fighting to convert a genuinely good partnership into real liquidity. Each bar sitting on the best governance structure in the sector, while the price refuses to acknowledge its presence. Stellar, quietly compounding real institutional wins without getting any of the attention it's earned. And XRP on top, not because every fight inside it is won, but because it's the only one of the 5 that it's already built the bridge to traditional finance capital, even if that bridge is sitting a little quiet right now. Notice something about the shape of this entire ranking, because it's not random. The order almost perfectly tracks how far each asset is moved from pure speculation toward actual institutional infrastructure. Flare's the furthest from that transition, still leaning almost entirely on technical promise. XDC has 1 foot in the door with Bridge, but hasn't built the liquidity to match. HBAR has the governance infrastructure, but not yet the usage numbers to justify it. Stellar has both the infrastructure and genuine institutional capital flowing through it, just without the attention it's earned. And XRP has the full regulatory and exchange infrastructure built out, even if the capital flowing through it has gone quiet for now. That's not 5 random stories. That's one story, told 5 times at 5 different stages of completion. So here's the actual question I want you to take away from this, though, because the ranking itself isn't the point. Every single one of these 5 assets is fighting a different battle. Flare is fighting for relevance, XDC is fighting for liquidity to catch up to its partnerships, HBAR is fighting to get the market to price in governance, the way it prices in hype. Stellar is fighting for attention it arguably already deserves, and XRP is fighting to turn infrastructure into sustained flow instead of a one-time approval headline. None of those fights are over. Every single one of these rankings could look completely different a year from now, and the reason is the same reason this entire sector is worth paying attention to in the first place. The infrastructure is real. The institutional interest is real, and the outcomes are still genuinely undecided. So here's the only question that actually matters after everything we just walked through. Out of these 5, which one are you holding, and which side of its fight do you actually believe is going to win? This video is for educational and informational purposes only. Nothing here constitutes financial, legal, or investment advice. Always do your own research and consult qualified professionals before making any financial decisions. If this ranking made you rethink where one of these 5 actually sits, hit like right now. It's the single biggest signal that tells the algorithm to put an honest breakdown like this in front of people who are tired of every ranking video just being a top 10 hype list with no actual reasoning behind it. Subscribe if you want the next one of these rankings. The moment the ETF flow data or the council usage numbers shift enough to move any of these 5 up or down a spot, because this order is not permanent. And I'm not going to pretend it is. Share this with the person in your circle who keeps treating HBAR's council or XDC's strike deal as the whole story without looking at what the price is actually saying back to them. They need the other half of this argument. Drop a comment and tell me straight. Do you think HBAR's governance story eventually drags the price up to match it? Or do you think the market's right to keep discounting it until the usage numbers actually show up? I want the real disagreement in the comments, not just 5 names and a fire emoji, 5 coins, 5 fights, 1 list. Go pick your side. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.